Hello, and thank you for joining us at xm.com. This is the weekly outlook. This week has crucial data coming up and, of course, a central bank meeting. Therefore, investors have a lot to look forward to. Helping me unfold this upcoming week's events is senior investment analyst Marios Hadjikyriacos. Marios, it's great having you with me. Let's start by having a look at the United States. Whispers about a recession have been going round lately, and the employment report out on Friday will be scrutinized for any signs of a slowdown in hiring. What are we likely to see in the data? What could that mean for the dollar?
Hi, Christina. Good to be back. Look, there's all kinds of talk about the recession lately. The market is looking at the whole situation. The housing market in the US is slowing down very dramatically because interest rates are going up. And there's all these kinds of whispers about companies cutting back on hiring. We heard from a lot of tech companies lately, giants like Amazon, Microsoft, Facebook, Nvidia. Everyone is either cutting back on hiring or freezing it altogether. There's this whole, a lot of companies are overstaffed essentially, or that's what they are saying. So here's what I think is really happening. The executives at all these companies, they're just looking at the economy and they're forecasting a slightly weaker economy. Not necessarily a recession, but a pretty substantial slowdown. So that means they need to manage costs in such a weakening environment. And how do you do that? You cut back on hiring. And here's the important thing. If this is happening at the biggest level, so for the trillion-dollar companies, it's definitely happening for the smaller companies as well, because wages and labor costs are a bigger expense for those companies. So it looks like the market is slowing down and like the economy is slowing down, and the bond market is already starting to price this in. We've seen yields on US government bonds coming down lately. That shows that the market is starting to shift away from freaking out about inflation towards being concerned about a recession. We even heard from a Fed president yesterday, from Bostic, and he was saying, yeah, we're gonna hike interest rates another couple of times, and then in September, maybe we can take a pause, see how everything is affecting the economy. So, in light of all of this, we're going to get the employment data on Friday. They're going to be very important. However, it looks like this whole story hasn't started to show up in the official data yet. It's just too early for it to show up. The forecasts are for a very decent employment report, and that is actually supported by a lot of the indicators for employment during the month. So yes, the labor market is probably weakening, but this is not going to show up this month. It's probably a story for next month or afterwards. Now, what's the picture for the dollar? Look, I'm getting some mixed signals lately. So on the one hand, there are some signs of trend exhaustion. We saw the dollar sort of top and then pull back a little bit, and that happened from very crucial levels. So, with US bond yields coming down as well, the dollar doesn't have this huge interest rate advantage anymore. However, I think it's too soon to call for a trend reversal. I think this is still a relief rally. And my argument is nothing huge has changed, right? The Fed is still on track to raise interest rates several times. The European and the Chinese economies are way, way weaker than the American economy is. And if we do get a global recession, that probably pushes safe haven flows into the dollar. So it's really difficult to call for a reversal in the dollar right now. But here are three things that would convince me otherwise. If the Fed pauses its rate hike cycle, or if the war in Ukraine ends, or if China steps away from zero COVID policies, then the argument of a trend reversal in the dollar becomes much more serious. Right now, I just don't see it.
Let's cross into Europe now, Marios. Inflation for May in the Eurozone area is expected to continue to climb. Can a high percentage point, though, tip the scales over at the European Central Bank for a more aggressive 50 basis points rate hike at its July meeting?
Well, here, the markets are certainly speculating about that. So in July, the markets have fully priced in a regular rate increase, and there's around a 40% probability for a double rate increase, half a percentage point. Now, look, obviously, if we get hot inflation data, that would raise the probability that they go for a 50 basis points rate increase. But I somehow doubt it. And the real reason is The European Central Bank is not the Fed. The Eurozone economy is just much more fragile. There's a reason they were doing quantitative easing for all these years. Just stopping asset purchases and then doing dramatic rate increases, that would imply a huge risk of instability in the bond market, especially for nations like Italy or Spain, for example. So I don't really think the ECB wants to risk that, so I think they're going to be a little more cautious than the market is expecting right now. Now, as far as the euro is concerned, I'd say we need something more for the euro to stage a sustainable rally. We saw a relief bounce lately. For that to become a real sustainable rally, I think we need something more than the ECB raising interest rates. And it's probably one of those factors that I mentioned earlier. The Fed pausing, China looking better, or the war in Ukraine ending, which is not apparent right now.
And finally, Marios, let's turn to Canada. The Bank of Canada meets on Wednesday, and markets have fully priced in a 50 basis points rate hike, which will most probably be delivered. But how can the loonie move on what policymakers have to say about future rate hikes this week?
Yeah, so you hit it right on the head. The rate hike is fully priced in, so the reaction in the loonie comes down to the tone of their statement. Are they optimistic? Are they cautious? And what does that say about future rate increases? I think they are going to be a little bit on the cautious side. So the reason is, yes, the overall Canadian economy is doing really well, actually. So unemployment at 5-decade lows, inflation is hot, the consumer is pretty strong, but the housing sector is in real trouble. The Canadian housing market is one of the few, let's say, bubbly areas that you are going to find. Prices skyrocketed in recent years. Now mortgage rates are going up, so prices are starting to come down, and this is a real risk for the Canadian economy. So I think policymakers are going to be a little cautious about that, and if that's reflected in the tone of the statement, that might argue for a slightly weaker Canadian dollar.
Marios, thank you for joining me today. This was the Weekly Outlook here at XM.com.